All right, let's jump right in. We are breaking down a really provocative, deeply contrarian take on one of the biggest stories in tech today, Microsoft's massive bet on OpenAI. Now, if you're a trader or an investor in the AI space, you need to hear this. We're looking at a new thesis that argues the popular opinion isn't just wrong, it's dangerously wrong.
So this is the title of a brand new Analyst report from a firm called TechOnion. And look, it doesn't pull any punches. It's framing Microsoft's entire AI strategy, not as some kind of masterstroke, but as a crisis in the making, a hostage situation where Microsoft is on the hook for $250 billion.
And here's where it gets really interesting. This is the stark contrast that defines the whole story. You've got this one report screaming crisis, but it's standing against an absolute army of bulls. A staggering 97% of Wall Street analysts rate Microsoft to buy. Not a single major firm recommends selling the stock. So this massive disconnect between the lone bear and the herd, that's exactly what we're going to dig into.
So, you have to ask, how can one analyst be so completely at odds with the entire market? Well, this report argues that Wall Street is just missing the fundamental signs of distress. The core idea is simple. The whole promise of AGI, that was just a fundraising pitch. The subscription model that was supposed to make it all work, it's broken. And OpenAI is now quietly squawking for help.
Okay, so what's the evidence? The first major piece of the puzzle, according to this report, is OpenAI's recent pivot to an advertising model. Now, the analyst presents this not as a sign of strength or some smart new revenue stream, but as an act of pure desperation, a last-ditch effort to stay alive. To really get this argument, you have to understand this term, stochastic parrot. It's kind of harsh, but the report claims that's all current AI really is. It's an impressive mimic that can string words together and sound human, sure, but it can't deliver reliable, measurable value for enterprise customers. And that right there is the core reason the subscription model is supposedly failing.
This timeline just illustrates the problem perfectly. The report draws a direct line to what it calls the Netflix lesson from back in 2022. Remember that? When Netflix, a hugely profitable subscription giant, hit its growth ceiling, it was forced to add ads. The argument here is that OpenAI is doing the exact same thing, but from a much, much weaker position. I mean, burning through $14 billion in a single year with zero history of profit. It's a whole different ballgame.
So, okay, if subscriptions failed, can ads really save the company? The report argues that OpenAI is facing an absolutely impossible challenge here. It's trying to break into a digital ad market that is a fortress, a duopoly completely controlled by Google and Meta. Those two command over half of all digital ad spending on the planet. The report says this isn't just bringing a knife to a gunfight, it's like bringing a knife to a thermonuclear war.
And this number, right here, is the crucial point. The report links the whole subscription failure directly to this statistic. It cites a 2025 MIT study showing that 95% of businesses are seeing zero measurable return on their AI investments. Think about it. If the product isn't delivering real value, why would the subscription model ever work at scale?
Now, this is where the thesis really expands. It goes from being a single company's problem to a massive sector-wide threat. The report actually outlines a potential chain reaction, a kind of contagion it calls the AI domino effect that could just ripple through the entire industry. And here's how it could play out, the 5 potential dominoes. It starts with the market leader, OpenAI, basically admitting its subscription model has failed. That pushes users to cheaper or even free open-source alternatives. In response, enterprises slash their AI budgets. And that's when the sky-high valuations across the entire sector collapse, as the market finally realizes the tech was just overhyped.
And according to this analyst, Microsoft is already showing signs of this crisis internally. This quote from the report is just brutal. It claims Microsoft is effectively paying a competitor, Anthropic, because its own massive, multi-billion-dollar investment in OpenAI isn't reliable enough for critical business tasks like working in Excel.
This slide really highlights a key strategic difference that investors need to watch. The report frames Sam Altman as the salesman, selling a grand, far-off vision of artificial general intelligence. But in contrast, it labels Anthropic's team as the missionaries, because they're focused on selling a functional product that solves business problems today. According to this thesis, the missionaries are the ones winning the actual enterprise battle. Okay, so for all the traders and investors watching, this brings us to the most critical, most immediate event, Microsoft's earnings report tomorrow. The report says this is where the theory gets tested with hard data. This is where the stock's next major move will be decided. And the report boils the entire earnings call down to these two simple triggers. The bull case: Azure's AI revenue has to be contributing more than 10% of total Azure revenue, while capital spending stays flat. But the bear case, well, a miss on that revenue target combined with accelerating Capex would be the ultimate red flag. It would signal huge cost with really low returns.
The analyst also suggests listening past the big headline numbers for specific keywords on the earnings call. The corporate speak. Bullish phrases to listen for are things like deployed at scale. But hearing vague terms like strong interest in pilots or excuses like capacity constraints, according to the report, that's just corporate code for it's not working yet.
So, after laying out this entire case, from the subscription problem to the domino effect and the key things to watch in earnings, what is the report's final actionable conclusion for investors? What's the bottom line?
The analyst gives 6 core arguments to justify the sell rating, and as you can see, they include competitive threats from Anthropic, the rise of open-source models, and a particularly alarming point at the end there, what the report calls Enron-style accounting risk due to potential circular revenue flowing between Microsoft and OpenAI. That's a huge red flag. And so the final verdict from the TechOnion report is a clear and unambiguous sell rating on Microsoft. It's a direct challenge to the 97% of Wall Street that's screaming buy, and it's urging investors to get out before the earnings call potentially proves this entire bearish thesis right.
And that leaves us with the central question for every single investor in this space. Is Wall Street's 97% consensus right? Is this just the cost of building the future? Or is this lone contrarian view about to be proven correct in the most dramatic way possible, turning a massive bet into what the report calls the most expensive autopsy in corporate history?